$900 silver should be the right price. That's obviously sounds crazy. Or adjusted for inflation, it should be at least $250. We have a 5x supply deficit in silver. That hasn't changed, whether that's electric vehicles, solar, Samsung components, massive demand drive. Let's not forget the LBMA market in London seized up in October. They didn't have the silver to deliver. T+1 delivery was like T+8 weeks. We remember post 1980, it could go from 50 to 5. I think we're in a very different environment now. There's a reason the BIS has made gold a tier 1 asset. There's a reason Morgan Stanley's pushing for it, or Jeffrey Gundlach, or Ray Dalio, or Druckenmüller, or Paul Tudor Jones. Even those like myself who used to trade risk assets, if they understand history and cycles, this bull market in gold is not even finished by any stretch, but it's not a bull market. It's a symptom of a very sick global monetary system.
Let's say gold goes to $10,000 in the next 5 years. What does the world look like in that environment?
It looks very bad. That's why we've always said, any of us in the space, from Egon, myself, Rick Rule, we buy gold not because we want it to go to 10,000, because we're afraid it'll go to 10,000.
Several people have told me that silver has gone up the way it has because of shortages realized in the industry. Tesla, Samsung, other companies couldn't acquire silver in the quantities that they need, especially and maybe perhaps because of the exports that export restrictions rather that China has imposed late last year. And so at some point, the market will reach equilibrium. It usually always does. What needs to happen before that happens?
Look, silver is fascinating, and certainly the topic du jour because of the exponential moves it made this year. I mean, broke 50, 60, 70, 89. It's incredible. It had a 60-year cup and handle formation. It broke through that. On the technical side, too, remember 1979, 1980, it broke through its gold-silver ratio and broke through it and went up 5x. The same thing happened in 2010, 2011, in 7 months, 2.5x move because the gold-silver ratio breakout. We had a similar breakthrough in November of 2025. So technically, the setup for for silver, I keep confused. The technical setup for silver is fantastic. And look, you can measure silver historically against the M2 money supply.
Industrial demand sounds like the headline driver. But liquidity cycles may be the real engine behind silver's move. As Matthew Piepenburg often reminds investors, monetary expansion measured through M2 growth has historically preceded major precious metal rallies, including the 1979 to 1980 surge. Global M2 rose sharply again between 2020 and 2024, and commodities tend to respond with a lag rather than immediately. Tesla and Samsung demand matters, but capital flows and currency dilution typically matter more for sustained bull markets. When technical breakouts align with monetary expansion, volatility usually increases alongside opportunity. Next, Matthew Piepenburg hints at why supply shortages alone don't explain silver's acceleration.
In 1980, you could say it's $900 silver should be the right price. That's obviously sounds crazy. Or adjusted for inflation, it should be at least $250. So there is a lot of technical and historical ways you could argue the bull case. I think the simple fundamentals haven't changed though, David, because look, we have a 5x supply deficit in silver. That hasn't changed. What happened in 25 that made it so different? Why is it suddenly spiking now? And I think the answer is that supply deficit is colliding with much higher industrial demand, whether that's electric vehicles, solar, Samsung components, AI power stations, massive demand drive. At the same time, there's a supply tightening. And then, of course, let's not forget the LBMA market in London seized up in October. They didn't have the silver to deliver. It's supposed to be a cash and carry exchange. T+1 delivery was like T+8 weeks. So you had a breakdown in the old systems that were traditionally putting a permanent short in New York and London on the silver price. But because of demand for metals, monetary and industrial, there's just not enough silver to make that play, to play that game.
Supply deficits make headlines, but delivery failures expose deeper structural stress in commodity markets. Matthew Piepenburg points to the October LBMA delivery delays as a warning sign that paper metal markets can diverge from physical supply realities. When settlement timelines stretch from T+1 to multiple weeks, institutional confidence can weaken quickly. Industrial demand from EVs and solar grew roughly 12% globally in 2025, tightening inventories across exchanges. That combination of physical scarcity and rising demand often forces repricing events that futures markets struggle to control. Next, Matthew Piepenburg explains why manipulation narratives become harder to sustain when physical buyers step in.
And as we saw in December of 2025, they tried to raise the margins on silver that created a temporary sell-off because of the margin hike, the buy-in on the poker table. But then what happened? The industrial buyers didn't panic when they saw that margin hike. They went out and bought it on sale and pushed the price up 4% within a week. So the old tricks to manipulate these markets are getting weaker. So we're getting more natural price discovery in silver. So those are huge tailwinds for silver. But again, remember, $200 silver, $300 silver sounds fantastic. But if we had had this conversation here, I said we'd be at 100 plus, that would sound fantastic. And I think, again, you can just adjust it for inflation or look at the technicals. There's a strong case. But also remember, silver can be, as Egon says, very hard, not for widows and orphans. And you remember post-1980, it could go from 50 to 5. I think we're in a very different environment now than 1980. But you've got to look at silver much more as a more volatile monetary industrial metal than gold. Gold's a pure monetary metal. I look at silver, it's like the NASDAQ versus the golden Dow. It's a lot more of a little speedboat that churns faster in a bull market, but can sink faster in rough seas. And so you have to be very different mindsets for silver and gold.
Margin hikes usually scare speculators, but they didn't scare industrial buyers this time. Matthew Piepenburg highlights December 2025 as a moment when physical demand overpowered futures market pressure, signaling stronger underlying demand than in prior cycles. Historically, silver lost nearly 90% after its 1980 peak, reminding investors how violent reversals can be in thin markets. A 4% rebound within 1 week after margin increases suggests buyers were waiting for liquidity events rather than reacting emotionally. For portfolio strategy, that means silver behaves less like gold insurance and more like a high beta commodity asset. Next, Matthew Piepenburg warns why volatility itself may become silver's defining feature in this cycle.
You're in the gold market on Greyers, so let's talk about your sentiment on gold and your client's sentiment on gold right now. The first question I think a lot of people have in their minds is right now, how sustainable is this gold rally? 50% gain last year, 50% gain the year before. That's 2 years in a row. And now at $5,000 gold, the fabled $5,000 point that people have been waiting for literally decades now. Does this remind you of 2007 or 2000, right before the tech bubble burst, or 1980?
Well, certainly in terms of the movement, but it's a fundamentally different type of bull market.
Okay.
It's a fundamentally different type of bull market, and this is not just sell-side bias. Look, I was in the dot-com bubble. I was there in the great financial crisis as a risk asset manager. I watched Lucent, Qualcomm, Microsoft, NVIDIA go up into the moon and Amazon go down to the bottom of the ocean floor. Those were bubbles and busts. And certainly on the, when I think of gold, it's a very different, frankly, far more disturbing type of bull market because it's not a trend or a sentiment or momentum just because it's sexy and in the headlines.
2 consecutive 50% annual gains in gold sound bullish, but historically they signal monetary stress more than market euphoria. Matthew Piepenburg frames this rally differently from equity bubbles like 2000 or 2007 because gold typically rises when real yields fall and debt expands. US federal debt crossed $34 trillion in 2024 and central bank gold purchases hit record levels the same year. Unlike tech bubbles driven by earnings expectations, gold rallies often reflect declining confidence in fiat systems. That distinction matters for investors deciding whether this is speculation or protection. Next, Matthew Piepenburg connects gold's surge to deeper structural shifts in global monetary policy.
What it really is a signal of, it's a symptom of absolute currency debasement to monetize debts that have gone from $250 billion in 71 to $38 trillion today. That is adding water to wine, that is diluting the currency, and gold and silver are ripping primarily because the US dollar or all fiat money is falling. So when you look at this appalling 5,000 price in gold or breaking 100 in silver, and people are looking at how can this be? It's so dramatic for the price. What it's really dramatically indicating is not that gold is so high, it's that that's how weak fiat money has become. That's being ignored completely. And I think even on a technical basis, Dave, look, you've seen these gold bearish troughs that go to bullish highs. And twice in the last 50 years, there's been 8x moves in gold. There was one in I think it was 76, another in 2001, where you had a bearish low, they went 8x up. Same thing in 2001, bearish low, 8x up. In 2015, we hit another bearish low cycle at the price of 1050 gold.
Gold's price surge looks like speculation, but debt expansion tells a different story. As Matthew Piepenburg emphasizes, US federal debt rising from roughly $250 billion in 1971 to over $38 trillion reshapes how investors interpret asset prices. Historically, gold's largest rallies followed monetary stress cycles, including the 1976 to 1980 run and the post-2001 expansion after the dot-com collapse. Currency dilution doesn't show up immediately in CPI reports, but it appears clearly in long-duration assets and commodities. Investors ignoring purchasing power risk may misunderstand why metals keep trending higher despite rate hikes. Next, Matthew Piepenburg connects these debt cycles to central bank behavior.
I won't spend a lot of time on the wonkiness, but since that move, we've only gone up 4x from that last bearish low. If we had another 8x cycle, even at 5,000, we're only halfway to that technical indicator. So there's technical support, but far more importantly, the fundamentals haven't changed. There's a reason central banks are dumping IOUs, dumping the dollar, de-dollarizing. There's a reason the BIS has made gold a tier 1 asset. There's a reason Morgan Stanley's pushing for it, or Jeffrey Gundlach, or Ray Dalio, or Druckenmüller, or Paul Tudor Jones. Even those like myself who used to trade risk assets, if they understand history and cycles, this bull market in gold is not even finished by any stretch, but it's not a bull market. It's a symptom of a very sick global monetary system. And I will say, I am secularly very, very, very bullish on gold and silver, but I will never say or never suggest that investors think that this is only up and to the right. We've seen major moments where gold's in a bull run from 71 to 80, for example, where mid-year through a gold run, it can break hearts. Same with silver post-1980.
When central banks accumulate gold, it often signals declining trust in currency stability. Matthew Piepenburg notes that central bank gold purchases reached record levels in 2023 and 2024, exceeding 1,000 tons annually according to the World Gold Council. Institutions rarely move this aggressively without long-term monetary concerns. The BIS classifying gold as a Tier 1 reserve asset after Basel III implementation also changed how banks treat gold on balance sheets. For investors, this isn't just technical momentum. It reflects strategic reserve diversification across nations reducing dollar exposure. Next, Matthew Piepenburg explains why even bullish cycles can punish impatient investors.
So anyone who comes into the metal space, especially gold, does it for monetary reasons. If you're looking at silver, you have to be informed about risk so you're not shaken out of a bull market, and you have to pick your exits carefully in silver in particular. Gold you just hold because it's better than fiat money. So there's a lot going on, but I am very, very convinced that we're not even close to peak gold right now, or peak silver. But silver is another conversation because it's a lot more volatile, but we're seeing a perfect collision of supply and demand mismatch in the metals colliding with a COMEX and a London exchange, which can no longer price fix these metals. So
what
that's
does peak
fascinating.
gold for you look like? Let's say gold goes to $10,000 in the next 5 years. I'm not saying it won't, but let's just suppose it does. What does the world look like in that environment?
It looks very bad. That's why we've always said, any of us in the space, from Egon, myself, Rick Rule, we buy gold not because we want it to go to 10,000, because we're afraid to go to 10,000.
Gold rising to extreme levels would likely reflect economic stress, not prosperity. Matthew Piepenburg argues metals function more like insurance than growth investments, especially during monetary instability. Historically, gold surged during the 1970s inflation crisis, and again after the 2008 financial collapse, when real interest rates turned negative. Investors sometimes treat gold like a trade, but its role is closer to portfolio protection during systemic risk events. Silver's volatility makes timing critical, while gold often behaves like long-term financial insurance against currency erosion. Next, Matthew Piepenburg explores how preservation investing differs from speculation.
That may sound disingenuous, but what we're saying when we say this, when gold is at 10, 20,000, that is, again, confirmation of what we've been warning for the last 15, 20 years. that the global monetary and credit system is no longer sustainable.
Right.
And it isn't. And gold is only reflecting that. When gold's at 10,000, the price of a couch or a pair of shoes is going to be very different too. It's not a get-rich trade. It's a preservation trade from dying fiat money. It's very important people understand that. Once you do, $10,000 gold is far easier to comprehend than $2 million Bitcoin. In other words, it's just a reflection of the currency system and the debt system, not gold being a craze or euphoria. And that's why it's so scary to see it at these levels. And look, I think the reason you see this stacking by central banks, the reason you see these conversations at the World Economic Forum, the reason you see Dalio and others pushing gold, the reason you see the BIS and Morgan Stanley pushing gold is they're building their ark before the rain.
When institutions quietly prepare for instability, retail investors usually hear about it last. Matthew Piepenburg points to central bank accumulation and institutional endorsements of gold as signals of long-term monetary concern. Ray Dalio has repeatedly warned about debt cycle transitions, while BIS policy changes have strengthened gold's role in reserves. Inflation doesn't just raise gold prices. It raises the cost of everyday goods, reducing real purchasing power across portfolios. For younger investors especially, currency risk can feel invisible until asset prices and living costs diverge sharply. Next, Matthew Piepenburg discusses how investor psychology shifts during long monetary cycles.
They keep saying, they know the rain is coming. Central banks know it, the BIS knows it. That's why they hold more gold than U.S. Treasuries now. It's insane. You got to watch what they do, not what they say. Even stablecoin issuers take their profits from stablecoin and invest it in gold. So watch what they're doing, not what they're saying. And sadly, this dramatic move towards the metals is actually a very depressing sign for the condition of the global fiat currency system and the global economies. And there's a very nervous world out there. Our clients are from 90 countries. Every conversation, they're coming in. And look, they come to us already converted. We're preaching to the converted. Their question isn't even about peak gold. It's just, how quickly can they get it? And again, that sounds flippant. They're holding it for 10, 15, 20, 30 years. And even if the price was dramatically retraced in that period, they know that bar of gold is going to hold its value better than whatever currency they're coming home from.
Central banks and stablecoin operators are quietly signaling mistrust in fiat long before headlines catch up. Matthew Piepenburg points out that central banks now hold more gold than US Treasuries in some measures, a dramatic divergence from conventional reserve allocations. Stablecoin firms converting profits to gold underlines the broader institutional concern over currency stability. Investors should recognize that these moves are a defensive posture, not speculation. The metals market reflects systemic anxiety across 90 countries. For long-term portfolio strategy, this underscores the importance of tangible assets over paper currency. Next, Matthew Piepenburg explains why retail investor behavior often mirrors these institutional signals belatedly.
Just on that note, you've talked to your clients. The kinds of conversations you're having with their clients, why are they buying gold now at above, let's say above $4,700? Because they haven't been just buying since last week. They've been buying for quite some time.
Yep.
Above $4,700, what was the reasoning and how have the rationales differed this time versus when gold was still at $2,000?
Look, Egon, my partner, started buying gold at 300. He'll still be buying as long as he lives because, yes, I wish I'd bought at 300 too. I bought closer to 1,800.
Yeah.
But I've had conversations over the years where, again, clients are calling, they're convinced of gold, but they're thinking, I think 1,900 is too high. I think 2,300 is too high. 2,800 is way too high. That's becoming less and less. Of course, no one wants to buy at an all-time high in any asset. But the gold investors are fairly sophisticated. Our minimums are very high. So these are people with a great deal of wealth, some decent, sophisticated advisors behind them or in front of them.
Buying at historic highs isn't necessarily greed. It's often a recognition of currency risk. Matthew Piepenburg highlights that sophisticated investors, like those buying above $4,700, treat gold as a long-term hedge rather than a short-term trade. Historically, institutional patterns show gradual accumulation through crises rather than timing the bottom. This cohort balances portfolio security with wealth preservation, contrasting sharply with retail panic buying during market spikes. Recognizing that high entry points are strategic, not reckless, reframes common narratives in headlines. Next, Matthew Piepenburg examines why patience and conviction matter more than timing for these investors.
They see the gold play 20 years out. They're not traders. They're not speculators. And because they see it that way, yes, they would have preferred buying it 3 years ago. But they're really asking, not what the gold price is. They're just kind of agreeing that whatever the gold price is down the road, it's going to be more valuable than the fiat money they're trading in. But of course, I don't like buying gold at these highs either. But I know that 20 years from now, when my kids inherit this gold or my grandkids are using it, gold's going to be higher than 5,000 or 10,000. I won't care as much then. But would I have rather bought gold at 300? Absolutely. Of course I would. No one likes this. But our clients really aren't asking about whether they're buying at the top. They want to get in. It's not FOMO. It's just realizing now the writing's on the wall. I wish I had been there. Should have been there yesterday. I wish I'd been there. I wish I had done this earlier.
Long-term thinking outweighs short-term timing in precious metals strategies. Matthew Piepenburg emphasizes that investors focus 20 years ahead, prioritize wealth preservation over immediate gains. While hindsight favors early purchases like $300 gold, the current cohort acts on recognition of systemic monetary weakness. This mindset reduces exposure to volatility and avoids emotional decisions during retracements. For portfolio strategy, it underlines that understanding currency erosion is more critical than entry points. Even temporary drawdowns are less relevant when the objective is multi-decade value retention. Next, Matthew Piepenburg explores why even late buyers can still secure meaningful long-term protection.
But of course, it's hard to buy at the top. I think silver's a little bit of a different conversation that can be a little more volatile, even though the technicals and fundamentals are good for it. The only way you can buy gold at these numbers with confidence and conviction is to have a much longer term view than you would, say, in NVIDIA or Qualcomm or Lucent or certain private credit pools or private equity pools, because this is a much longer play. It is a preservation play only. Those who wish to speculate and buy entries and exits in metals, I know a lot of them, few do it well. That's a very different mindset. I'm not against it, but it's a very different mindset than the clients we have. But honestly, even clients that have been there for decades are just buying more. And the new ones are coming in just finally convinced. And of course, they wish they'd seen this earlier. Now these prices are shocking them, not because they waited too long, but that's proof that the system's breaking. But again, these prices can retrace, and people want to wait for, there could be a 30% retracement if the markets crash, for example, or there's a recession. The question is, will gold retrace 30% from 5,000 or from 10,000? Because if you're waiting for a 30% retracement and you wait too long, you could be better off buying now. I do not know. No one knows. And that is the dilemma. And I'm not going to just say ever, with any credibility that gold only goes up and to the right. Of course it doesn't.
Yeah.
And I'd remind anyone investing, if you're buying for the right reasons, prepare for retracements and pullbacks. But be a big boy, be a big girl about it if you're holding it for the right reason.
There may be monetary reasons for why gold went to $5,000.
Timing the top is almost irrelevant when the system itself is structurally unstable. Matthew Piepenburg notes that even sophisticated investors face a dilemma. Waiting for a 30% retracement could leave them underexposed if systemic monetary deterioration accelerates. Silver's volatility adds an extra layer of risk, while gold acts as a preservation asset, not a trading instrument. Historically, long-term holders weather cycles far better than those attempting precise timing, making conviction and patience the key drivers of outcomes. Portfolio strategies should focus on risk-adjusted preservation rather than market timing illusions.